Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. This week we're going to touch on Canada's trade data, what has changed, what has not changed, and what stood out to me and what it might mean for Canada going forward. Every month, Statistics Canada publishes data on Canadian exports and imports. It is a comprehensive data set that covers merchandise, also known as goods, or visible trade across several main sectors and hundreds of product categories. Statistics Canada also publishes data on services, but in this video, we're going to focus on goods. So let's start with the headline. In May, Canada's merchandise or goods exports were up 1.1%, while imports fell 1.6%. As a result, Canada's goods trade deficit with the world narrowed from $7.6 billion in April to $5.9 billion in May. If you squint, you can see a slight uptick from the lows of last month. Notably, last month saw numerous headlines claiming that April had the largest trade deficit ever. And yes, in April, the Canadians' goods deficit was horrible. However, headlines claiming it was a record low are misleading. Due to the monthly volatility in the series and some seasonality, the data should be viewed as a 12-month moving average or total. That is the smooth royal blue line on the chart before you. And as you can see, Canada has had larger trade deficits before. Another way of looking at the change in trade deficit is by breaking it down into exports in dark blue and imports in light blue. And here we can really see the impact of the tariffs, or that is to say, people front-running the tariffs. Exports first jumped in anticipation of the tariffs and then subsequently fell. And in May, they rose slightly. With respect to tariffs, it is our view that it is way too early to get a read on the longer-term implications. A deal may yet be struck before long, and some key sentiment indicators like business confidence and the stock market seem to be brushing off the worst of the possible outcomes. Another way to look at trade is, of course, by destination. And again, you can see the impact U.S. tariffs are having on Canadian exports to America. As a reminder, tariffs are like a tax paid by the importer. It is U.S. companies that are paying the tariff, which they will try to pass on to their end consumer. By contrast, exports to other countries other than the U.S. are rising. The problem is the difference in scales on the charts. The jump in exports to other countries simply cannot make up for the fall in trade with the U.S. This stark economic reality is made crystal clear when looking at the following chart: goods exports by country or region. As you can see, this chart exposes Prime Minister Mark Carney's tough talk of pivoting trade away from America as pure theater. Canada is not going to pivot anywhere. Yes, new markets for our goods are, of course, welcome, but when it comes to international trade, proximity, and in Canada's case, pipelines especially matter. Proximity is straightforward. All else being equal, trade is easier and cheaper with countries that are closer. But I emphasize pipelines for two reasons. The first is oil. Canada's humongous oil exports are critical to our trade balance. Without oil export, Canada would be faced with a massive internal devaluation, less consumption, or a massive external devaluation, a lower currency. Of course, Canada exports and imports plenty of other goods and services, but for inflation and the currency and our current account balance, what matters is the net figure. And as you can see, Canada's surplus in red is dominated by natural resources, with energy products, specifically crude oil, by far the biggest. And so how does Canada export its oil? Well, it does so via a network of pipelines that is over 400,000 kilometers long. This vast network allows Canada to sell U.S. a product they desperately need. heavy crude oil to complement their light, sweet product that dominates their oil production. This time, the chart exposes Donald Trump's attacks on the U.S.-Canada trade deficit as completely baseless. Excluding energy products, the U.S. has a trade surplus with Canada. In any event, Canada's proximity and its pipelines mean that the U.S. will always be Canada's biggest trading partner. However, there are changes afoot. Canada's crude oil and equivalent exports to the United States as a share of total is starting to fall. Yes, I know it's still 94% of the total, but the construction of the Trans Mountain Expansion Project, aka TMX, has allowed this to happen by expanding the capacity of the Trans Mountain Pipeline by 500,000 barrels a day from 300 to about 800 or so. To the elbows up crowd, it should be very obvious by now that the easiest, most efficient, and safest way to find new markets for our most important export is to build east-west pipelines across Canada. This long overdue investment significantly boosts the Canadian economy and its energy sector. It should infuriate every Canadian that the current governing party worked tirelessly to block pipelines that would open our exports to new markets. Nowhere was that intransigence more obvious than with natural gas. I'll remind Canadians that we were told there was no business case for exporting natural gas to our NATO allies that were desperately in need. This was, of course, an outrageous lie. Thankfully, the free market prevailed, and just a few days ago, a tanker carrying the first cargo of liquefied natural gas, LNG, from Canada set sail from British Columbia's northern coast to Asia. There was always a business case to sell natural gas, and one tanker will not be enough to mitigate our exposure to our neighbors to the south, but of course, every little bit counts. Finally, we'll touch on another interesting point from this week's trade data release, and that is the jump in gold exports. Admittedly, this jump is a bit overstated as these figures are values and not volume. So that means the data is distorted by the rise in the gold price that we've seen of late. Nevertheless, the contribution cannot be overlooked. Going forward, this is an area we'll be keeping a keen eye on. Just like crude oil, natural gas, and the pipelines from east to west, the Liberal Party has promised to make mining much easier in Canada. And this is a good thing too, because central banks all over the world are buying gold, and as we've discussed before, critical materials and rare earth minerals are going to be increasingly important going forward. All right, that's a wrap on this week's episode. Thanks very much for watching. Please like, subscribe, and follow for more. And as always, we manage money for families all across Canada and the world, so feel free to get in touch.